Good morning, everybody. This is Josh and Jeremy for the Keystone Q&A today. Glad that you're all with us today. We're going to go ahead and give people a few minutes. We're a few minutes before 9 here Mountain Time, so we're going to give people a few minutes. I can see a few people signing in now, so welcome everyone. We'll give people a few minutes to get plugged in here, and then we'll get going. So yeah, I can see Ann signed in. Good morning, Ann. Yeah, we'll get going here in just a moment. One thing I did want to point out, and I'll mention this a few times, of course, is that if you'd like to ask a question, and of course we love questions, so if you'd like to ask a question, the way to do that actually is by emailing. I know that's a little bit old school, but our compliance people tell us that's what they require. So you need to email that to jeremy@keystonefinancial.com. So certainly keep that in mind as we get going here. Yeah, this year has certainly been full of news, hasn't it? Yeah, we'll get into that here in just a few minutes. Of course, you can see a few more people signing in. So thanks for joining us this morning. We'll give it another minute or so here. We like to start right on time and certainly end on time. I know that, certainly you giving up part of your morning, depending on where you are, giving a part of your morning, whether you're supposed to be at work right now or whether you'd rather be doing something fun, playing golf, who knows what that would be. But certainly we respect the fact that you've taken time to be with us, and we want to make sure that we end on time. So we'll definitely be done by 10 o'clock Mountain Time. And as always, we're recording these, so they are available as a replay afterwards as soon as we can get them approved by our compliance people, typically as a day or two. And those will be located out on our YouTube channel. So give people just another couple seconds, and then we will get going. And as we're coming up on 9 o'clock here, another reminder is if you'd like to ask questions, and I see my phone hit 9 o'clock. So if you'd like to ask questions today, please email those directly to jeremy@keystonefinancial.com. Again, our compliance people are requiring that we do it that way as opposed to using the GoToWebinar features. So thanks for being flexible with us on that. But as we get going here, we've been doing these since March, right? We've been doing these presentations, and the reason why we started these up is there was just an extraordinary amount of volatility that really erupted after it was clear that COVID, coronavirus, whatever you want to call it, but after it was clear that that was going to be a big deal, that it was going to have a big impact, not only people individually from a health standpoint, certainly, but from an economic standpoint. It's certainly been unprecedented, some of the actions that we've seen over the last couple of months, not only from an economic standpoint, right, and governors and the president and mayors and whoever's in the authority over certain areas, right, shutting stuff down, and certainly it's impacted all of our lives, right, the way we go about our day-to-day lives. I think a lot of us feel like in the last couple of weeks we've started getting back to normal a little bit, right, as things have opened back up. But it's never been tried before. Really, what we've done over the last few months as a world, right, as a nation, it's never been tried before. Where just everything has been shut down, from churches to schools to businesses. Certainly, it's had a massive impact, and of course, certain sectors have been impacted more than others. Certainly, a lot of tragedy that comes with a lot of that, not only from loss of life but loss of business too, really, for people that had businesses, many of which were very healthy businesses up until, right, things started shutting down, and then just boom, right, if you were a restaurant or a church, or if you were a hairdresser or anything like that, your revenue may have gone from really good to zero overnight, right, and probably negative, right, because you've got expenses, and so your profits actually probably went negative for a while. And unfortunately, there are a lot of businesses that probably will not make it or did not make it through this, regardless of government assistance. And so certainly we're wrestling with that, and the markets are wrestling with that, because remember that the market's always trying to figure out what's next, right? What's coming in the future, not about what's happening right now. So I know for some people they wonder on a day-to-day basis. Hopefully everybody doesn't watch the market every day, Jeremy and I kind of have to, right? Because this is what we do. But hopefully people don't watch it that closely. But for a lot of you, you may wonder, why did the market do what it did today, right? Say if there was some really bad news that came out from the previous day or something like that. So the market's up, what? And vice versa. Let's say that there's a bunch of good news and the market's down. Really, why did the market react to that? Because the market's not reacting to what's going on right now. The market is and somewhat, right, it does have some impact, but really what the market is asking, and that's all of us, right, we're all the market, is trying to ask at any given moment is, what does this mean, right? What does this mean for the future? Not right, what does this mean for right now? What does this mean for the future? And in particular with the stock market, the question that's really being asked is, what does this mean for future profits, right, of companies? Because at the end of the day, that's what a company is there for, right? That's its primary objective, is to be profitable and to return those profits to investors. So really what the market is trying to figure out, whether you're looking at an individual stock or looking at the broad market like the Dow or the S&P or the NASDAQ, really that's just a collective, and of course this is collective every millisecond, right, these days, but certainly an opportunity for us to all evaluate every millisecond what we think is going to happen in the future. So keep that in mind. But as we get going here, a couple of things. So a number of you signed in here while I was talking, so again, welcome. Thanks for being here. And for those of you who have been attending a lot of these, thanks for sticking with us really over some crazy months. Really, there's been some crazy stuff that's happened over the last few months, stuff that we maybe have never seen before. So it's kind of ironic that our forecast presentation was called Ready for Anything. Maybe we shouldn't have titled that. Maybe we jinxed this whole thing, right, by the title of our webinar originally, or our seminar. But certainly being ready for anything, I don't think that's anticipating necessarily or trying to outguess what's going to happen, right, or trying to predict the future. Certainly there are a lot of people paid for that are trying to figure that out, and most of the time they're wrong, right? At least half of them end up being wrong as far as economists and strategists and so forth. But really there are time-tested principles, right? There are time-tested principles, and certainly the wisest way to move forward in anything, right, from a sport to a hobby to a career, is not to do things by trial and error, right? That's the hardest way to do it, the most painful way and the most lengthy way, right, to figure anything out. Sometimes that's a necessity, right, if there's no precedent, if there's nobody who came before us. But really, there are a lot of really smart people, right, and very successful investors like Warren Buffett, for example, we pay a lot of attention to. The guy's 89 now, something like that. And still goes to work every day. Isn't that crazy? I mean, he's perfectly happy. He says he actually tap dances to work every day. Very happy individual, stops and gets his egg McMuffin in the morning, and away he goes. So again, as we get going here, you can email questions to Jeremy at keystonefinancial.com. Josh and Jeremy, we are the wealth advisors, financial planners, whatever you'd like to call us. Typically, there's a lot of, in our industry, there's a lot of different job titles that get thrown around. And it's important, not necessarily just the job title, but what do those people actually do for you? What are their jobs? And I can tell you that for the most part, our industry traditionally has just been salespeople, right? It's been people that call themselves a financial advisor, investment advisor, whatever it might be. But the reality is that they probably are selling a product, right? They're probably selling a product, and they probably work for somebody else, right? And they're being paid commissions to sell that product. So with us, we are actually a fiduciary. We are fee-based. We don't charge any commissions on our investments. So that's a good thing for you to note, that you're only paying us a fee, not a commission on any investment stuff that we've got going on. So the disclosure slide you can see here at the beginning, a necessity, but more or less what this says, the most important point to get out of this is, of course, these are our opinions. We don't know what's going to happen in the future. Hopefully you realize that by now, right, after the last few months. And really the comforting thing for all of us, certainly for us as advisors and for you as individuals, is to realize that even the smartest people with all the information, now we're talking about the biggest hedge fund managers, the biggest strategists, the most successful traders, even right the top people that would seem to have all the information, the president and the Federal Reserve chairman, people like that, they don't even know, right? They didn't know either. They didn't know that things were going to get this bad. And certainly not only that things were going to get as bad as they did, but I think a lot of people were surprised, and really I am too, right? Surprised at how fast that things have bounced back. over the last couple of months from the depths of the bear market that we experienced. So keep that in mind. Nothing we talk about is guaranteed, of course, and these are just our opinions. One thing to keep in mind is where we are, and I think it's instructive to look back over the last couple of years. 2018 was not a good year for the stock market. So our memories can be pretty short these days, especially when the media really tries to tell us, hey, what's happening every millisecond matters, right? And so we've got this 24/7 news cycle, very easy to remember. Remember the present, forget the past. So 2018 ended up being a dud of a year, right? The market actually had a good year up until the fourth quarter, and really it was only the last month or so, largely created by the Federal Reserve, actually. And oftentimes is the case. Recessions oftentimes, or pullbacks, oftentimes it is as a result of the Federal Reserve, which tells you how much power they've got. So the S&P 500 ended up being negative. I remember it was the worst Christmas Eve in stock market history. As financial advisors, we always think, oh, that's a day we can just take off and not worry about things. And of course, it didn't turn out that way in 2018. So then 2019 ended up being a great year. It was kind of hard to make money in 2018. It was kind of hard not to make money in 2019. Right, pretty much every asset class was positive for the year. Now in 2020, of course, where are we today? So the market actually started out pretty good for the year, and then after the end of February, we hit all-time highs. The Dow was about 29,000 at that point. So the S&P 500, which we like to use the S&P as opposed to the Dow, even though I think we all probably pay more attention to the price of the Dow, right? But the S&P 500 actually started out January 2nd when the markets opened at about 3257, and right now today we're at about 3047, which if we don't include dividends, that's about a 6.5% decline. So if you had gone to Mars, and returned now, say if you left for Mars on January 2nd and returned right now, saw the level of the market and didn't hear any of the news, you'd probably think, well, it's kind of a boring year. It kind of stinks, right? Things are down a little bit, but not a whole lot happening. So certainly that leaves out a lot of drama that happened in between. And of course, the year isn't done. What I think we can see right now is that certainly the world is getting back to the new normal. There's never going to be an old normal. So I think for anybody that thinks, well, everything's just going to go back to the way it was, I think we're all smart enough to realize that that's not going to happen. And that never happens, right? Stuff changes and we need to figure it out and move on. And that's what's happening both for individuals and the government and for businesses right now, is figuring out at least what that new normal is for the economy and for us in our individual lives, and then moving on accordingly. So the one thing, remember what I said before, is that the stock market is a forecasting mechanism that we're all participating in, right? So it's a forecasting mechanism, and the market is trying to guess, and that's all of us, right? We're trying to guess, well, where are things going in the future, 3 months, 6 months, a year from right now? Are things going to be better, worse, the same as they are right now? So I kind of like the where the market is right now. Not to say we're out of the woods by any means, but I kind of like where the market is right now, because I think what it's saying is, that we've probably averted, a depression. We've averted a massive pullback that we can't come back from. And in fact, believe it or not, some strategists are actually saying that the market could actually not only regain all the losses that were had back in March and April, but also that we might even see all-time highs get hit again by the end of the year, depending on a couple of things. The two things I think, anyway, from what I've been reading: number one, the vaccine. Certainly that seems to be a game changer, that there are companies now that say they have a vaccine that is effective and are testing it right now. So that's kind of a race among pharmaceutical companies to come up with a vaccine and come out to be the first ones that come out with the one that works, right? So that's the ultimate solution, right? That will put this to rest. But also, I think a recognition that, maybe this isn't as bad as what was once feared, right? Maybe the losses, the damage that we once thought would happen, maybe it's not as bad as what we think, and actually companies will end up figuring it out and moving on by the end of the year. So the one thing to keep in mind, as always, is that from a behavior standpoint, that is the number one thing, number of studies that we can look at, but that is the number one determination of an investor's success over time is really their own behavior, their own decisions that they make along the way, not necessarily just that the investments that they own or just the stock market. In the short term, that can make a difference, certainly, but in the long run, it's people's individual decisions. And, that's also, I think, your individual advantage. Dr. Crosby, which we've referenced in the past, he mentions the fact that people are fallible, right? We all are, right? We all have our biases. We all have our own fears and so forth. And so those are things that if it's just us, right, and we don't have any sounding board, we don't have anybody else helping us out and kind of guiding us through. That's why Jeremy and I have jobs, right? because we act as that impartial side of things, right? That we're not you, and I have people that I reach out to even on my own finances, believe it or not, even though I'm a financial advisor and I know everything, right? Supposedly, right? I've taken all the tests and everything like that. But the reality is we're still fallible. We're still fallible as individuals. And so it's a good idea to get a cross check. And people's fallibility, of course, and their own biases tend to throw them astray, especially in the area of finance, oftentimes because of the news of the day. That's where I've repeated this before, and I'll say it again, is that we need to act as the gatekeeper of our own minds every single day, not only for finance, other areas of our life, right? And so one of the ways that I always suggest people do that is to make sure that you're at least rationing the amount of news that you're intaking. And this is not a political discussion. This is not me making any comments in any particular news organizations. I think they all have their biases, right? But keep in mind that overwhelmingly the news media reports negative news. So not necessarily saying that they're reporting false news. It might be true, right? There could be a lot of negative stuff happening in the world, and I think we certainly could have a discussion about that, right? Over the last couple of weeks, stuff that's happened in Minnesota and other areas, some really disappointing, frustrating, terrible situations. So, and certainly the coronavirus, which, right now with all the riots and things going on, we've all kind of forgotten about the coronavirus, right? And it's on to other stuff. So just keep in mind the market and the media always are going to be kind of reactive, right? And kind of looking at what's going on just in the moment. And it's important to be the gatekeepers of our own minds, because otherwise we're just going to think the world's terrible, right? If that's all we paid attention to and that was our only lens to look through was whatever the news media is reporting, that's whether it's conservative, liberal, whatever it is, you would think, well, the world is terrible. It's a horrible place, right? If that's your only lens. So just keep in mind that, it's one of those areas, and I have to do this myself. I was a political science major for my bachelor's degree. I think politics very interesting. I think the news is very interesting, and so it's very tempting, for myself too, to consume too much of it. And I can tell you that my own emotional state gets impacted by it, right? If I'm too much into the media, too much, checking what's going on in the news and the world, it can very quickly turn me to a negative place. When in reality, there is a lot of good stuff out there. There's a lot of good information, good news, things that are happening in the world. But of course, that doesn't get reported because it's not as sensational. And so, I think it's important to be the gatekeepers of our own minds. Also being focused on our goals and being focused on what's the point behind all this, right? Why are we investing? Why did we invest in the first place? It really was because of financial goals. It was dreams that we had. It was things that we were putting money towards, or maybe still are putting towards if you're still working right now and in that accumulation phase versus the other phase, we call it the distribution phase, right? When people are starting to actually draw off of their wealth, draw income off of their wealth. So really keeping in mind what's the whole point behind all of this. Were we trying to grow our money? Are we still trying to grow our money? Or really is it an objective? And maybe it's different buckets of money, right? We talk about different buckets of money people have, and you might have a bucket of money that really is meant to grow, and you might have a bucket of money that's really meant to be more secure and more about preservation. So you might have another bucket that you don't, basically it's just all out preservation, like cash in the bank, right? Where there's no objective of making any money. Right now, it's pretty hard to do that in the bank with interest rates at their current levels. So keep in mind not only your objectives, but also keep in mind your time. And we put age on the original slide here, but I don't think age matters really when it comes to investments. Really what it comes down to is people's time frame. When are they going to need the money? So those two things will definitely impact certainly where allocations should be in people's portfolios and how we design those. So there's definitely a purpose behind all of your portfolios, right? If your clients, those are very purposeful as far as how they're designed, and really sticking to those strategies and rebalancing over time can make a big difference. This slide actually talks about, I'll hit it briefly. We've hit it in the past. You guys can watch replays on it, but I think it basically just proves the point that people that try to jump around and try to outsmart the market, uh, I would say never. And Warren Buffett has said that he's never met somebody who can correctly time the market, consistently over time. So I'm with Warren. I've never met anybody either who can consistently do it. Do you find people who get lucky? Yes, absolutely. Did they get lucky? Did somebody get lucky in February and they, got some wild hair and said, I'm going to cash out all my stuff and just put it in cash or gold or something like that? Can you find somebody that did that? Sure. Yeah. Can you find somebody who did that and they got it right the time before and the time before and the time before when there were market pullbacks or bad news that was going to come out? No, you can't find that. And I think the slide here, when they've done studies on this, they've actually shown that when you miss some of the best days in the market, you end up getting terrible returns. Actually, and Morningstar, others have done studies on this that show that the average investor's return, really over long periods of time, tends to be pretty bad. The average investor doesn't do well, and they've actually gone back and figured out why, because they can track flows in and out of the market, right? As far as when money is being put in versus taken out. Well, a lot of it is that timing, right? It's emotional timing, because when people get scared, what do? They tend to run, right? That's just our natural instinct as humans. And then when things get good, right, then people tend to want to buy. They don't want to miss out. So that fear and greed cycle is a lot of what we're talking about when it comes to behavioral finance. So there are good reasons. It's not to say that people should just have a set it and forget it portfolio. In other words, I don't believe in that either. Right? I don't believe that you just buy a portfolio and you never change it, and that there's never a reason to change it. So, certainly some people subscribe to that philosophy and just say, hey, just put it, invest it and never look at it again. I think most people will say there are some reasons, right? Maybe your goals have changed. Maybe the economy has had some significant change to where it's affected your job or your business or something like that, right? Where you're not in a financially secure position anymore, whereas you may have been earlier on. So certainly lots of examples of that, of business owners that looked like they were very solvent and very profitable, very quickly became unprofitable. And again, depending on how much cash they had available, if they ran out of cash, they probably didn't make it, because that's why a business dies ultimately, is because it runs out of cash. And there's been government assistance, things like that have helped out with that to inject some additional cash into businesses. But for the ones that didn't have enough, basically, or maybe they just had a cost structure that was too high to be able to make it through, there will certainly be a lot of businesses that never reopen. At the same time, there are a lot of businesses that are born. That's the good news. A lot of businesses are born in depressions or recessions and pullbacks. Oftentimes, that's a time that creates an opportunity for others. So it may sound kind of callous, right? It's certainly not to minimize anybody's pain personally, but certainly that's a time, a recession is a time where there's a lot of stuff that changes, and certainly the winners and the losers of businesses quickly get determined. So major life events, rebalancing, we talk about rebalancing a lot, because that's one method that, many studies that we've looked at have shown that rebalancing a portfolio periodically, a lot of what I've seen is quarterly, is the most effective. So that's what we do here at Keystone. What we tend to do is look at it on a quarterly basis, just doing routine rebalances to portfolios. But sometimes, if there's dramatic moves in the market, sometimes there can be reasons to do it in between. Rebalancing can actually enhance returns and reduce risk over time. And so certainly we can talk about that in a bit if anybody has individual questions. So, and then, maybe the fundamentals have changed. We have to be a little bit careful about that, because, sometimes I think it's very easy to delude ourselves into thinking that, well, fundamentally everything has changed, and the whole world is going to go into a depression, and it's going to be like the 30s, right, where it takes 10 years for things to come back, and we're going to have people in soup lines and so forth. I just don't see that happening. I think the odds of that happening have gone down considerably. We talked about earnings. Certainly that's the most important thing for a company, is its earnings, as far as its future earnings, as far as its current stock price. And then, ultimately, we want to just be aware of our own biases. Just be careful about what you're paying attention to, and be very careful about trying to make decisions based on single points of information. So I think that one thing that I've seen oftentimes is that people will latch onto one piece of information or one news story or one thing that could happen, and then they want to base their entire investment strategy off of that, or they want to run for the hills, right, and say, well, I'm going to take all my money and put it in cash because of this might happen or that might happen. Or on the opposite end, sometimes we'll see people that say, you know what, I think this is going to happen, so I want to take way more risk than I have been in the past. And of course, it's your money, right? We can't force you to do something, right? Because we're just here to guide you, not to make your decisions for you. But I can tell you that oftentimes is not a winning strategy, to be kind of whipsawing the risk and the allocation of a portfolio. Rarely works, and I would say again, never works consistently over time because of these emotional biases. So with that, that I just wanted to make a few points. Again, one thing I wanted to mention too is that many questions have come up over the last couple of months with our clients, our investors, and they might say, you know what, I don't get it. Why the market isn't down more than it is right now, or I don't get it. Why is the market going up when things are so terrible, when the unemployment rate is so high, the GDP numbers are so bad, the earnings reports are so bad. We're hearing these companies like Hertz, is out of business now. They're declaring bankruptcy. Pier 1 Imports is bankrupt. There's a number of companies that have declared bankruptcy. So people say, well, why is the market where it is right now? How can it be so high? So a couple of points. Number one, the market, again, is not reacting necessarily just to what's happening right now. The market's trying to figure out where things are going forward. And again, I hope the market's right. I really hope the market's right, because that would say that, there's some optimism, right? That things are going to get better, and maybe even better than we once thought, as far as how quickly we kind of get out of the mess that we've been in, right, economically. Maybe the jobs numbers, all these things can reverse course here, and certainly could by the end of the year. That's the bet that's being made right now, I think, in the market in general. The other thing is that the market tends to climb a wall of worry. That's a catchphrase in our industry, as far as kind of what tends to happen is that the market actually tends to do well, and do well even ahead of those good times. So again, don't be paying attention to the news currently. If you go back to the financial crisis, the last major downturn that we had back in 2008, 2009, you might remember, and I certainly do, at the time, that 2008, gosh, I mean, even the smartest people, the Federal Reserve Chairman Ben Bernanke, they didn't even know, what was going to happen, right? Was the entire financial system going to collapse? So there were a lot of experiments that were done at the time, and thankfully those experiments worked, and things turned themselves around. But certainly there was a lot of things to be negative about. So the market came back dramatically in 2009, and certainly I think we bottomed out on the Dow about 6,600, 6,700 back in March of 2009. But really, all of 2009, there were still a lot of fear. There were a lot of news reports that maybe things are going to go back down. 2010, 2011, 2012. If you go to every single year, be a student of history, go back and look at some of these years and all the negative things that happened. So that's somewhat instructive for right now, in that I think we can look at a lot of negative news stories, negative things that could happen or have happened, and say, well, because of that, things are going to be really bad, things are going to go back down. And it's not that we can't guarantee that they won't, right? Jeremy and I don't know any more than anybody else in the short term what's going to happen. But just keep in mind that the market does, and oftentimes in its best performance times, tends to climb a wall of worry. And so it's those early investors, if people are trying to time things, it's those early investors that tend to do the best. They tend to get the highest rates of return. And I would argue again that the highest rates of return come from people that will buy and will not, they invest in a strategy, and they don't try to be crazy and jump in and out all the time. So with that in mind, I just wanted to throw that out to any questions that you've got. Jeremy at KeystoneFinancial.com is how to ask those questions, and then we'll go from there.
Yeah, Josh, and so far we've gotten one. Really, it's I'll sum it up. Really, it's asking about how worried should we be, or should we be worried about national debt, and how that's climbing, and how is that going to impact things short term and long term?
Yeah, I think the worries there, in my opinion, right? I think the worries are less now than what they probably were even a month or two ago, just because we didn't know how deep of a hole we were going to get in. And again, it's not to say that we're out of the woods yet economically, but there are some early signs of optimism, right? That the economy is getting going again. People are spending money, people are starting to travel. people are starting to buy cars, right? I mean, all the numbers that we were seeing look horrible before. A lot of those numbers are starting to improve right now, and even some early unemployment numbers, as far as unemployment filings, believe it or not, are starting to show some improvement. So the other thing to keep in mind is that this was a self-imposed recession in a lot of ways, because of the fear of that, hey, if we don't do anything, if we kind of go back to the root of this, if we don't do anything here, you could have millions of people die. And maybe we would have, right? We don't know that. There's no way to turn back the clock on that. But the consequence of, of the pandemic and how many people could have passed away just wasn't acceptable, clearly, to everybody. I mean, I think most nations and most people said that no, that's not acceptable to have that risk, and so we are going to shut things down to flatten the curve, right? That was the original intention. Is not that, hey, we're going to try to keep people from getting the virus. The original intention was that we've got to flatten the curve, because how tragic would that be if we had a situation like Italy, or I think New York even had for a period of time, where there just wasn't enough medical care and people were dying just because of lack of care, that the hospitals couldn't keep up with with the care that was needed. So I don't think any of us are on any illusion, because this is an extremely contagious virus, that we might all get exposed to it, right? And I think that's the way that I'm operating kind of going forward, is that the number one thing I can do is make sure I have a really healthy immune system, right? Because at the end of the day, if I have a healthy immune system, that raises my odds of not having severe consequences, right, from getting it. So, now that we're clearly past that curve, you can chart it out based on, pretty much every country and every area. Not to say that there can't be some resurgence, not to say that things can't come back in the fall, but clearly we've accomplished that objective of being past the curve. And so I think collectively, right, every state now in the nation, every locale, right, is opening up to some extent, allowing different things to open back up. Of course, it very much depends on where you are, right? Some have become very liberal and just kind of opened everything back up like it was before. Some are doing it more cautiously, and I think that's the majority of what we're seeing. So as far as debt, I think the big thing to look at from a debt standpoint is the fundamental thing is, if you can keep borrowing, if you're still credit worthy, and we certainly have that, right? There's a huge amount of demand for U.S. Treasuries that keeps interest rates low, or keeps our debt service low. And as long as we can make the payments on that debt, we end up being solvent. When we run out of cash, that's the problem, right? Is if this had turned out to be a much worse recession than it is, right? And we think, there are early signs we're going to come out of this thing, that it's going to be a relatively short recession, very severe but very short, that the debt to GDP numbers will come back down. When it comes to individuals, let's say we all went out and applied for loans right now. One of the primary things, and early in my career, I was actually a loan officer, so I know this well, is that probably the number one thing that we looked at was people's debt ratio, their debt to income ratio. And so what we wanted to do is we wanted to say, well, can they pay this back, right? What are the odds that they're going to be able to make the payments on this thing, whatever it is, a house or a car, or whatever it was they were borrowing money for? So a debt to GDP ratio is the same thing. The lower the debt to GDP ratio, the better. So, and currently we're at elevated levels right now. We've certainly seen a spike, but the trend that we've been on has not been particularly concerning, especially compared to a lot of other countries that are much debt heavier and still are solvent. Certainly Japan, has been very high from a debt standpoint. Most of the European economies, much higher debt levels. What are the consequences? Probably a slower growing economy. We may actually see slower growth as a result of too much debt. And oftentimes that can happen with companies too, and individuals, is that it really hampers their ability to grow. So what we're hoping is that this is a momentary spike. We've seen that before. Back in World War II, we saw a massive spike in the debt to GDP ratio, massive amount of spending, of course, that had to happen, right, to be able to get through World War II. And we saw it come back down afterwards. So what we've done effectively is we borrowed from the future in a way, because there'll be future things, of course, because you can only borrow so much, right? There will be a point where where people are not willing to loan you money anymore. Or they start to say, well, we'll loan you money, but at a much higher interest rate. And of course, that is a downward spiral, because the higher the interest rate, the higher the debt payments, and that can get ugly pretty quickly. So there's a lot of stuff we have to wrestle with in the future. Of course, Social Security, Medicare, a lot of stuff that is not currently fully funded. That stuff is coming sooner than we think, in the late 2020s, early 2030s. So those are issues that will have to be wrestled with down the road. But I'm not particularly concerned about short term. Long term, it could be an issue, and it could cause some inflation problems.
Mm-hmm. And actually, that is the only one that's come across so far this morning.
All right, sounds good. And one thing to keep in mind too is these Q&A webinars that we've been doing for the last few months. The one thing to note is that we've been calling them a Q&A webinar on market volatility, but I think we need to reframe those a bit, and we will reframe those a bit. We've got a podcast that's going to be coming out that got delayed a bit from we had a baby a month ago. That tends to throw a wrench into things, but a podcast coming out, so that'll be one way that we'll be communicating that will somewhat replace what we've been doing. But also, I think there's been some value in this. We've heard feedback from clients that have really appreciated the fact that we've got some way virtually, right? In the past, we've had more seminars, more places that people can come and ask questions, but I think we're going to be doing this for a while, right? Where it's all virtual. So, having some way, and so keep an eye out, in your email. We will have these periodically. It won't be called Market Volatility Q&A. Maybe it's just Keystone Live Q&A. That's kind of the working title that we've been operating off of, is that we'll have some live opportunity for people to ask questions and hear what other people are asking as well. And certainly it's been an unprecedented time of market volatility earlier on in this. That was really why we said, what, we need to do something a little bit different, a little bit more frequent here, because things are changing so quickly. There's so much uncertainty, and we want to be the antidote to the fear, right? Because in the end, fear and greed, that cycle and getting stuck there, that will lead people astray very quickly. And left to our own devices, right? If we don't have some other sounding board, not just financially, there's a lot of other decisions we might make out of fear that aren't necessarily in our best interest. That we want to be the antidote to that, and to make sure that you're able to not only sleep at night, that's important, right? Just you emotionally, but also when it comes to making decisions, that really people are making good decisions really with their finances, and sound decisions based off of principles, not based off of what's happening in the market right now, or what is happening in the news media, or what the president says, or what the governors say, or what, Fed chairman, anything like that. That stuff, it's not to discount it and say that it means nothing, but in the long run, it doesn't mean much. And I think for those of you who know your history really well, and this goes back to the beginning of the country, there's always been a reason to be fearful. There's always been a reason to not invest or be really pessimistic about the economy or the world. But equally, there's a lot of things that are going right too. So just keep that in mind, that a balanced approach, and if you're hearing a lot of negativity in the news, just recognize, well, but what are they in the business of? Ultimately, they're in the business of making money, right? They're a company too. Their objective is profitability, and how they make their profits is by selling ads. And how do they sell ads? They get lots of people to watch, because the advertisements are worth more if you get more viewers. And I can tell you, because it's been tried before, for news organizations that only report positive news, they don't make it. They don't do very well. And maybe that's a sad commentary, on all of us, right? That we don't want to hear the good news, or we get bored with good news. But the reality is that there's always a balance between the two. So keep an eye out, certainly, for opportunities in the future. We're not going to stop doing these altogether. There will be an opportunity like this in the future to do a Q&A format, but also keep an eye out for the podcast, and certainly bounce any feedback to either one of us. My email is just josh@keystonefinancial.com. Jeremy's is jeremy@keystonefinancial.com, because we do get feedback from clients frequently. We have a client advisory council. We ask a lot of our clients individually really what they're appreciating and what they'd like to see from a communication standpoint or an education standpoint. Those are always things that we've prided ourselves on, that we do make a lot of effort there, right, as far as being proactive with keeping in touch with our clients, mostly because studies have shown us that most advisors aren't very good at that, and that's one competitive advantage that we've got, right? That doesn't involve trying to time the market or deal with things that we can't control. So that's a lot of the focus that we end up putting on, is really trying to educate you as our clients and have a lot of communication. So we understand you well, you understand us well, and certainly by doing that, it establishes trust, and it certainly establishes a situation where our clients aren't just blindly making decisions or not involved at all. We definitely never want that. We definitely want this to be a partnership with all of you. So with that in mind, we'll go ahead and wrap it up for today. Again, there won't be another market, I hope not anyway, unless things get crazy again like they were, and then we'll kind of ramp these back up. But it's not to say there won't be opportunities. So certainly keep an eye on your email. Also follow us on social media. We're now on Instagram as well. Easy way to follow us, just go to our website, keystonefinancial.com. And now we're on all the major social media, Facebook, Twitter, whatever you look at, basically, we're probably on it. But Instagram is our newest channel, so definitely connect with us that way as well. Yeah, with that, I just wanted to thank all of you certainly for taking the time. And again, I know some of you have been on like every one of these, which is great. The fact that you've been here and certainly you've found value out of this. So with that in mind, I hope you have a great week. Anything else, Jeremy, that you can think
one
of?
quick parting thought, Josh. To our clients, we are starting to transition back into the office. And so most of the client meetings are still being held virtually right now. But we do, some of us are still in the office in case you need to drop by or anything like that. But we have instilled a mask policy inside the office. And so we just let you know, if you can let us know when you're coming by, that way, we can be safe for you, you can be safe for us, et cetera, until further notice.
Yeah, good point. Yeah, it'll be interesting to see over time, which none of us know, right? But it'll be interesting to see how many people choose to continue to interact virtually as well. And that's available even if you live down the street. I mean, you may prefer this. You might say, you know what, I like my one-on-one meetings to be done virtually. So I think that's one thing that we've gotten very, very comfortable. We were somewhat comfortable before, but now we've all gotten very comfortable, and you probably have too, right? At virtual meetings. So we certainly will give you the opportunity either way to meet in person or meet in person virtually. So otherwise, yeah, I think that's it. I hope you all have a great week, and certainly appreciate your support and appreciate your partnership and your trust. Thank you.
Take care.